As the U.S. markets are currently closed for the weekend, NewAmsterdam Pharma Company NV, trading under the ticker NAMS on the Nasdaq, closed its last session on Friday, October 10, 2025, at a price of $37.05 per share. This represents a significant intraday surge of $4.04, or an impressive 12.26% gain on the day. Now, seeing a double-digit pop like that on your screen, whether you're using a sophisticated interactive brokers platform or the accessible Robinhood app, might lead to a simple conclusion. It's just another volatile day for a clinical-stage biotech firm. That's the surface-level expectation. The reality, however, is far more specific and tells a much more compelling story about risk, validation, and the shifting winds of institutional sentiment. That 12% jump wasn't just random noise or broad market optimism. It was the market pricing in a very particular piece of the puzzle, a development that suggests the company's primary asset is moving from a high-stakes gamble to a statistically more probable success. For investors who are used to the more predictable, though sometimes equally volatile, movements of giants like Apple stock or Nvidia stock, understanding this distinction is absolutely critical. The common narrative surrounding a company like NewAmsterdam Pharma is that it's a binary bet. The company essentially lives or dies on the results of its clinical trials. Investors, especially those doing self-investing or using a SoFi robo-advisor, are taught to see these stocks as lottery tickets. You buy in, you hope for positive data, and you either see a massive return or a catastrophic loss. This is the prevailing wisdom, and for many pre-revenue biotechs, it holds true. But Friday's price action challenges this simplistic view. The powerful buying pressure, which was evident in the trading volume that day, suggests that the market is beginning to look past the binary outcome. The expectation is that NAMS is a coin flip. The emerging reality is that sophisticated investors, perhaps using advanced analytics on their Fidelity trading platform, are seeing the coin as weighted. They are not just betting on the final outcome of the pivotal PREVAIL cardiovascular outcomes trial. They are reacting to accumulating data, positive safety signals from earlier studies like Broadway and Brooklyn, and the growing medical consensus around the drug's mechanism of action. This shift from pure speculation to calculated probability is where the real opportunity for online investing lies. The retail trader sees a stock that went up. The institutional desk sees a risk profile that just improved demonstrably. Let's dissect that recent market activity more closely. The 12.26% surge was not an isolated event. It's part of a broader uptrend the stock has been experiencing over the past several months, punctuated by moments of intense buying. The volume on Friday was substantially higher than its daily average, a clear sign that this wasn't just passive index fund allocation. This was active, aggressive buying. This is the kind of volume that indicates new, large positions are being built. An individual brokerage account holder at a place like Schwab might not see this, but digging into block trade data reveals that institutional players were likely the primary drivers. These aren't traders making a quick flip. These are large Fidelity wealth management clients or hedge funds making a strategic investment based on their deep due diligence. They believe the current price does not yet reflect the full potential of the company's lead drug candidate, Obicetrapib. Furthermore, if you track analyst revisions, you'll notice a pattern of upward price target adjustments from key healthcare analysts. When a respected analyst upgrades their rating or significantly boosts their target, it acts as a green light for portfolio managers who need third-party validation before committing significant capital. This is a classic case of Wall Street building consensus, and the price action is the most visible symptom of that process. While the macro environment, with its fluctuating interest rates, creates headwinds for many growth-oriented companies, including speculative giants like Tesla stock, specific company positive news like strong clinical indicators can create an entirely separate weather system for a stock like NAMS. So what does NewAmsterdam Pharma actually do? Stripping away the market dynamics, the company is at the forefront of tackling cardiovascular disease, one of the leading causes of death worldwide. Its main focus is a drug called Obicetrapib. This is a next-generation CETP inhibitor designed to dramatically lower LDL-C, often called bad cholesterol, which is a primary driver of heart attacks and strokes. The key here is the target patient population. While statins are incredibly effective for many, a large segment of the population is either statin intolerant or cannot reach their target LDL-C levels with statins alone. This is a massive unserved market. Obicetrapib aims to be a convenient, once-daily oral pill that can be used as an add-on to statins or as a standalone therapy. The business model is classic biotech, incur significant research and development costs for years with the goal of bringing a blockbuster drug to market. Their entire valuation is currently pinned on the future revenue stream from this single asset. Unlike a diversified company with Fidelity mutual funds or Fidelity ETFs in its portfolio, NewAmsterdam is a highly concentrated bet. The success of this one molecule could create a multi-billion-dollar enterprise, while failure would be devastating. This is the fundamental risk-reward profile that makes online investing in this sector so compelling and so dangerous. Platforms like SoFi Invest and Interactive Brokers have made it easier than ever to participate in these opportunities, but the need for thorough research has never been greater. Looking ahead, the future of NewAmsterdam Pharma is defined by a series of clear, high-impact catalysts. The expectation is that FDA approval is the finish line. The reality is that the journey to and beyond that point is filled with crucial milestones that will shape the company's ultimate value. The most significant event on the horizon is the data readout from the PREVAIL trial, the large-scale cardiovascular outcome study. This is the trial that will prove whether lowering LDL-C with obicetrapib actually leads to fewer heart attacks and strokes. Positive data from PREVAIL wouldn't just be good, it would be transformative. It would solidify the drug's clinical profile and pave the way for regulatory submissions in the US and Europe. Here's a question for everyone watching. Based on the existing data from their Phase 3 studies, what percentage of the cardiovascular treatment market do you believe obicetrapib can realistically capture within its first 5 years post-launch? Comment below with your thoughts. Beyond the clinical data, another major catalyst is the potential for a partnership or an outright acquisition. Large pharmaceutical companies with established cardiovascular sales forces are always on the lookout for promising new assets to fill their pipelines. A small company like NewAmsterdam could be an attractive target, and a buyout offer would likely come at a significant premium to its current trading price. However, the path forward is not with substantial risks. The biggest risk, of course, is a failure in the PREVAIL trial. If the data is disappointing or reveals unexpected safety concerns, the stock's value could plummet dramatically. This is the harsh reality of biotech investing sites and the nature of the business. Even with approval, the company will face a fierce commercial battle. They will be competing against established blockbuster drugs and therapies from pharmaceutical giants who have deep pockets and long-standing relationships with doctors and insurers. Gaining market share will require a flawless commercial launch strategy and significant marketing spend. There's also financing risk. While the company is well capitalized for now, clinical trials and drug launches are incredibly expensive. They may need to raise additional capital in the future, which could dilute the ownership stake of existing shareholders. Investors using Schwab Intelligent portfolios or other diversified strategies are insulated from this kind of single-stock risk, but those with concentrated positions in NAMS must be acutely aware of it. The decision to invest here isn't just about believing in the science, it's about understanding the financial and commercial hurdles that still lie ahead. It requires a level of investment help and due diligence that goes beyond just reading headlines. In summary, the story of NewAmsterdam Pharma is a perfect illustration of the tension between market expectation and underlying reality. The expectation is that of a volatile, high-risk biotech stock, a simple binary bet on a clinical trial. The reality, as suggested by the recent powerful stock movement and institutional conviction, is that NAMS is a company that is systematically de-risking its core asset. The narrative is shifting from a question of if Obicetrapib will work to how big the market opportunity will be. For the self-investing community using platforms from Fidelity to SoFi, the key is to look beyond the daily price fluctuations and understand this fundamental transition. The recent 12% gain wasn't just a number, it was a signal that the smart money is growing increasingly confident in the science and the commercial potential. While immense risks certainly remain, the balance of probability appears to be tilting in the company's favor, and for those who have done their homework, the road ahead looks increasingly promising. The content shared on this channel is for educational and informational purposes only. It should not be considered as financial, investment, or legal advice. Always do your own research or consult a qualified financial advisor before making any investment decisions. If you found this video helpful, don't forget to like, comment, and share, and subscribe for more.